What's up, everyone? It's Caddy with Money Investing. So markets here green on the day. However, lots of intraday weakness with the S&P 500 closing in at over 39.82, so up a little bit over 31 basis points. The Nasdaq was also green, up over 60 basis points, closing in past 11,466, and the Dow Jones up over 22 basis points. However, every single index here intraday sold off, and on the daily candle we did have a red candle on a green day. So hope you guys are doing great and are having a great start to the week. Make sure that you drop a like, and of course don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below. Don't forget, today is literally the last day, February 27th, 28th, when the 16% annual discount does expire for everyone. So if you want to take advantage of that, link is going to be down in the description below. It's the second link down in the description. And also, you'll get access to all the trade alerts, trade ideas, options alerts, and I posted a very educational and super helpful tutorial on how to analyze a stock like a pro. And this right here is a 27-minute lecture, which you can watch. It's my entire blueprint, like complete framework with over 40 plus checklist and every single thing that you need to pay attention to when you're analyzing a company, analyzing a stock from a fundamental analysis standpoint, technical analysis standpoint, and industry analysis standpoint. Everything is covered in this framework. So if you want access to all these private videos, make sure to check out our Discord link. Link's going to be down below. So first things first, we do have earnings scheduled for this week. A lot of companies are reporting. In fact, actually 6% of the S&P 500 is scheduled to report earnings this week. A lot of them are going to be retailers and travel and entertainment companies, some fast food companies. But Zoom did pop after hours after reporting their numbers. So I will be doing a video on them later today. And then we've also got Target, we've got Blink, we've got AMC, Neo, Lowe's, Kohl's, Costco, all these companies reporting later this week, and I will be doing a video on all of them most likely after they've reported their earnings. So when it comes to the economic calendar, durable goods came out this Monday, and we did see durable goods contract a little bit more than what the consensus was. We'll break that down a little bit later in the video, but we did come down 4.5% versus the consensus of 4%, which obviously resulted in this gap up on the day, considering that markets were once again trying to anticipate that the Federal Reserve is going to be a little bit more dovish considering the contraction in the economy that we are witnessing. And of course, this week we've got lots of other stuff coming out, such as the manufacturing survey numbers, the PMI numbers. We've got ISM manufacturing index. So a lot of things that are going to be very important and give us insights into how the economy is doing. So stocks closed higher following the worst week of 2023. Again, last week was pretty much the worst week of 2023. Major indexes are on track to end February with declines, though. We talked about it during our live streams. And stocks rose Monday as investors tried to recover some ground following the worst week of the year on Wall Street. The Dow Jones up 72 points, S&P gaining 0.3%, and the Nasdaq up a little bit over 63 basis points. And the move comes in as Treasury yields eased following a jump on Friday after the hotter than expected reading from the Federal Reserve's favorite inflation metric, which is the PCE, personal consumption expenditure. We talked about it over the weekend and last Friday as well. Ross Mayfield, investment strategy analyst at Bard, says, and I quote, "Because of the renewed focus on hotter inflation and the implications of the Fed rates are once again driving equities, and the rapid shift in the Fed funds expectations and the spike in short-term yields has been risk off in the stock market, so some reprieve on rates today will likely boost equities as well." And that's really the kind of scenario we're in right now, is that rates are once again driving equities. If you notice back in 2022, when interest rates were going higher, when the bond yields were pushing up, they were putting a lot of downward pressure on equities. And for some time, there was a disconnect between equities and bonds. But once again, as we are seeing rates push higher, closer to 4%, the 10-year yield sitting at 3.9.5%, that's once again putting pressure on equity valuations, putting pressure on discounted cash flow models, putting pressure on the cost of borrowing, putting pressure on reinvestments between businesses. So there's a lot of stuff that we need to pay attention to if we are going to be on top of this. So holiday shortened week was more than enough for a time for the bears to remind everyone that January's rally didn't mean much in the stock market, volatility had been permanently exiled, and investors are coming to grips with rates being higher for longer, and Friday's hotter than expected inflation data effectively confirmed just that. And yes, PCE came in pretty wild on Friday. Now, in terms of the equity risk premium, so we have talked about this in our previous videos, and something that I think needs more attention because ERP was pretty much ignored or disregarded in the years to follow the financial crisis. And some investors had named this phenomena TINA, which stands for there is no alternative other than equities. So there was no other place to put your money other than equities because equities were outperforming everything. Equities were doing really well. But the situation has reversed once again with inflation and expectations of a more difficult economic environment weighing on expectations for corporate profits. The nearly guaranteed returns, which is the risk-free rate, has obviously pushed higher. We've got the 2-year yield sitting at over 4%. We got the 6-month yield sitting at over 5%. So you got short-term bonds sitting at much higher yields. And as a result, there is an alternative as opposed to equities only. And that's, I think, driving a little bit of that risk-off environment in the market. And definitely, putting a lot of pressure on equities. Goldman Sachs CEO also said today that having, quote, very tight job market makes cooling inflation very, very hard. So during Friday's episode of the Exchange at Goldman Sachs podcast, CEO David Solomon noted that the U.S. currently has, quote, very, very low unemployment, and that the job market across the economy was very strong, and having a very tight jobs market makes cooling inflation very hard. And the reason is because of several different things, right? This is something that we have talked about, and I think it's really well linked, because if people have jobs, they're still generating income, right? They're still making money. And as a result, it makes it more difficult for inflation to come down, even though prices are high, right? So if people are making money, they're willing to spend, and they are able. The most important part here is able. They're able to spend on whatever items it is that they need, right? Not only that, they're able to service their loans, they're able to service their debt, they're able to make rent, they're able to make their mortgage payments. All these things drive and kind of make it seem like the economy is really, really strong, even though inflation is still elevated. If for any reason we start to see unemployment start to creep back up, right? We start to see unemployment in the 5, 6, 7, 8% ranges. That, I think, is going to be what drives inflation down further. And that's, I think, Jerome Powell's even mentioned that himself. That is going to be a very, very welcome move in unemployment. Like, they actually want economic pain. But the problem is they're not getting any, right? Even though they've mentioned in their previous press conferences that we want economic pain to cool inflation down. So they're welcoming it. They're welcoming a higher level of unemployment, but they're not getting it right now because the jobs market is so tight. Quite an interesting predicament here. Durable goods, as I mentioned earlier, coming in very, very soft. In fact, going down more than what the consensus was, 4.5% month over month. New orders were down substantially versus the consensus of 4%. And this once again sparks this, concern that the economy is not growing as fast or as strongly as what we expected before. And once again, reigniting those expectations of the Federal Reserve to cut rates or pause rates. This right here, the entire market, Tesla here, very strong ahead of the March 1st Investor Day presentation. Amazon flat, Google flat, Microsoft, Apple flat, Nvidia slightly higher, Broadcom slightly higher, AMD slightly higher. And then it was really just the technology and big tech pushing higher. We did see some weakness in utilities and healthcare. A little bit of energy and consumer defenses were selling off. A lot of financial and fintech stocks and technology and services and cyclicals, all of them pushing higher on the day. This right here is the entire market with Union Pacific pushing up over 9% on the day, and ASML also up over 2%. This right here is going to be year to date and where we are for the first month and a half, almost 2 months for the markets, with Nvidia, Tesla, and Meta being the big leaders, up over 60%, 40%, and 68% respectively. Amazon, Apple, Microsoft also up. Amazon and Apple up in the double digits, low teens, mid-teens. Financial stocks are higher. We got cyclicals and semiconductors doing really well. The sectors that are not performing so well are going to be healthcare, utilities, energy, and consumer defensive. So once again, it's a very, very risk-on environment so far year to date. but it doesn't take long for that script to flip moving forward. This right here is going to be those forward price to earnings multiples, valuations, something that we have to pay attention to. Amazon and Tesla are trading at almost identical PE multiples at almost 37, 38. We got Nvidia trading at almost 40. We got the entire software sector. I mean, take a look at this. CRM, Intuit, we got ServiceNow, we got Uber, Shopify. Their price earnings multiple is just off the charts. Autodesk at 23 is actually not bad. Then we got Square at over 30. Microsoft and Apple are quite reasonable, in line with what we have seen in the past, their average PE multiples. Financial stocks, obviously a lot lower, a lot cheaper. PayPal, for example, among the fintech names, is trading at 13 times earnings. Meta and Google in the communication services, really, really low, both trading at roughly 14 and a half. Energy obviously has been a lot lower. Consumer defenses surprisingly is a lot higher. And then we've got real estate, very, very red. And then healthcare companies, biotech companies more specifically, trading at substantially higher PE multiples as well. This right here is going to be those price to sales multiples for all these companies. So once again, what you'll notice is energy obviously trading at a much closer to 1. Now with price to sales, I think there's no right or wrong answer. I mean, with P multiples, we know what the average P multiples have been. With price to sales, though, it can range anywhere between 2 to 6, 2 to 8. Those are some numbers to really look forward to when it comes to price to sales. And, there are companies that are in that range. There are companies that are trading way out of that range. So, for example, Nvidia, I still don't understand how this company can be trading at 21 times sales. Like, who out there is willing to pay 21 times sales for this overvalued stock? Like, it's absolutely crazy just to think about it. Microsoft 9.3 is definitely a little bit on the high end, but Microsoft is Microsoft. I mean, it can demand a higher multiple given the quality of the business. Apple at over 6. We got Google at 4. Meta at just under 4. PayPal at just over 3. Amazon under 2. It's an e-commerce business, so it's always traded at a lower P multiple and price to sales multiple. We got Tesla trading at over 8. Again, Tesla is Tesla. It can demand a little bit of a higher premium, in my opinion. Energy, lower. Consumer defenses, lowers. And healthcare companies, healthcare plans, also lower as well. But overall, you can start to see there's more red than there's green, definitely suggesting the markets overall, in general, on an aggregate basis, trading at a little bit of a higher valuation than what we are used to. So on the day, most sectors were green except for utilities. Over the last 1 week, energy is still kind of outperforming here. Everything else is down. And over the last 1 month, industrials are the only sectors that is green. All the other 10 sectors in the S&P 500 is red. Sugar prices climbing higher. We got lumber and orange juice also for the win, with the natural gas and lean hogs here pulling back, with Bitcoin just trading at a little bit over 23,000, Ethereum just over $1,600 at the moment. So volatility back under 21, so it was down a little bit over 3.3%, so selling off a little bit. And we've got energy here, so Boyle, we talked about it during our live stream. People wanted me to check that out. It was up over 8.5% as natural gas has seen a very good rebound, and oil prices here just flat on the day, trading past $75 per barrel. And Bitcoin here just consolidating sideways as well. It was starting to push back up, but sellers once again stepping in to bring us back under 24,000. So we were at one point trading almost at 24,000. And Ethereum here also was trading all the way up to 1665. We're back under 1640 right now, just flat on the day so far. Now, talking about the markets, S&P 500 first. Again, red candle on a green day. What does that tell you? What does that logically tell you about the momentum of this market? It is not very strong. It doesn't take genius to figure that out, because intraday we're seeing selling pressure. So today was nothing but a gap up. We came down to fill that gap, period. So again, we're at that support at 3980s, 3970s. It's going to be very interesting for us to see how the remainder of this week plays out, because we do have a lot of retail companies, a lot of food companies, lots of interesting companies reporting earnings. So that is going to be that support. If for any reason we continue to sell off, if for any reason we get those economic data, economic reports that are suggesting for the Federal Reserve to continue hiking rates and keep raising rates, that's obviously not going to be great news for the market. So keep a close eye at this higher low. And right now I'm watching that next support down to 37.75 in case we see a more dramatic sell-off here remainder of this week and next week. And this right here would be an opportunity for me to go long on S&P 500 or even individual stocks or even leverage ETFs as a potential swing trade. So that's right there is what I'm going to be paying attention to moving forward. Talking about the NASDAQ, once again, we're at support. This right here is going to be that level, close to 11,400, 11,475. Of course, resistance all the way up to 12,280. So right now we're seeing a little bit of a pullback, but once again, we're in this dilemma, we're in this uncertain environment where there's a lot of indecision and red candle on a green day, suggesting there's a lot of intraday weakness for the market. So support level is going to stay put roughly around here at 11,475. And if you do sell off even further, then this lower high, previous resistance, is going to be next, sitting at 11,200. And of course, all long opportunities and swing trade ideas are going to be on if for any reason the NASDAQ trades all the way down to low 10,000s once again. Talking about Apple first, and Apple once again green on the day, green candle, barely though. So we did see some sellers stepping in. Lots of consolidation for Apple right now, just mostly trading sideways. So we got a pretty big resistance sitting roughly in the 150s for Apple. We're consistently getting rejected at that prices. Support level is going to stay put at 137. So this right here is going to be that level to watch, and resistance stays put around this resistance at close to around $157 per share. Talking about Amazon, and Amazon here on the day, again, green day but a red candle, and support level is going to stay put at about $90, $91. So lots of weakness intraday for Amazon. Support level is going to stay put here. And both Amazon and Google are actually going to be on my dollar cost averaging list, considering that they are coming down pretty well. They are coming down to some reasonable levels. So I would be a lot more excited and more into dollar cost averaging those two companies. Next up, we're going to talk about the big stock for the week. We got Tesla pushing up 5.4%. So very strong move to the upside. It is still in the context of this bull flag. So I'm not gonna write off the possibility of a potential breakout from this bull flag for Tesla. It is possible, right? Considering how well it's just trading sideways in that range. So this right here is gonna be that resistance, of course, sitting roughly at around 200, 228, around those levels. And if you do get a breakout, in my opinion, it's possible for Tesla to retrace back up to 260s. My strike call is at 250. I'd be happy to trim some of my position at 250s. But next resistance really is going to be $269, $270 for Tesla once, if and when we get that breakout. And that could happen after the investor day on March 1st, or it could be a big bust considering and knowing Tesla's historical events. It's possible it's kind of like buy the rumor, sell the news type situation. So when the time comes, we'll analyze it. But right now, very strong day. But potential bull flag in the making, resistance at 228, and a support level sitting in the 160s. Talking a little bit about PayPal. And PayPal here on the day, 0.3% green. So once again, red candle, but a green day, suggesting some intraday weakness. Resistance going to stay put at $75, $76. So this right here is going to be that level to watch, and support level is going to be pretty much at this gap that we need to watch here at around $73 to $70 per share, so in the low 70s for PayPal. But PayPal actually is another stock that I'm looking at dollar cost averaging right now, considering how much it's been selling off. It's coming down to a reasonable support, oversold RSI MACD. So Amazon, PayPal, and Google are going to be three companies that I'm very interested in dollar cost averaging. I can safely kind of say that their valuations are not incredibly high. Of course, you can make a case for Amazon, but as we've already mentioned before, Amazon's not optimized for profitability. Their goal has never been profitability, but moving forward under Andy Jassy, maybe they can focus on generating positive earnings per share and really focus on profitability. But of course, there's a Rivian aspect to that as well. But PayPal, Google, reasonable valuations. I think they can be considered as good value here for your money and at that support, considering how oversold we also are. Talking a little bit about Square, and Square on the day was down almost 3%. So once again, seeing a little bit of selling pressure here, breaking below this area of support at just under $76. And really what it's been doing is just been consolidating and trading in this downtrending channel, right? So this is the overall downtrend within which you can see that, Square's been trading at. So we push higher, sell off, come down to this lower low, get rejected at this lower high, lower low, lower high, and we're just kind of trading in this very small downtrending channel. So next support really according to this is going to be at $66.50 to all the way down to $58, $59 per share per Square. And at $59, I would be interested in a potential swing trading opportunity on the long side for Block. So that's going to be that support level. In fact, I was quite impressed with their earnings and what they reported, but it's just about execution and can they actually become profitable over time. So Square at $59 will potentially be a swing trading idea for us, and I will share when the time comes that potential idea there. Talking about NVIDIA on the day, once again, green candle, actually red candle on a green day. Support level is going to stay put at roughly around $231 per share. This right here is the gap that NVIDIA may need to fill eventually. But again, trading at 70 times earnings, 21 times sales, absolutely just doesn't make sense. Be careful with this stock. It's kind of like a ticking time bomb in my opinion. NVIDIA is. So next support really is going to be at $230. So this right here is going to be that level to watch all the way down to $189, close to $190 per share. Talking about advanced micro devices and AMD, again, we've got a green day but a red candle. And we're once again at almost that support at $78, $79. So this right here is going to be that level to watch for advanced micro devices. And next support all the way down to as low as $72 per share for advanced micro devices moving forward. So that right there is going to be that level to watch for AMD moving forward. We've also got a small gap to fill for AMD. Talking about Meta and Meta platforms here, pushing down 0.5%. So a little bit of selling pressure here. Once again, we're slowly and steadily kind of drifting lower for Meta. Resistance is going to stay put at roughly 183. So this right here is going to be that level to watch, with support staying put inside sort of like this, white rectangle, which is also a gap that it needs to fill. And all the way down to 153 is going to be that next support. And Meta also can be considered as a good value for money because of the valuation that it trades at. I mean, price to sales, we looked at just over 3, price to earnings at 14. So it's really not that bad considering at 170, but I think we can get some better deals for Meta in the 130s, 120s. So this right here, a gap to fill, support 153, and buy targets are going to be closer to 120s for Meta. Talking about Netflix, and Netflix on the day getting a huge rejection at 332. So we did get a little bit of a bounce on the day, green day, but a red candle. So 1.85% green, back up to 323. Big resistance sitting at roughly $332. So this right here is going to be that level to watch. And right now we are seeing some sellers stepping back in and seeing a little bit of momentum to the downside. Support level is going to stay put at 276 for Netflix. So this right here is going to be that next level to watch as a support. And of course, low 200s is where I would personally be interested in buying Netflix for the longer term, because that's the fair value that I have calculated on Netflix. Talking about Google here coming down. It's again really oversold here, both on the RSI and MACD standpoint. It's got a really important support at roughly around $86, $87. So inside this green rectangle, we've got a big support level to watch for Google at those prices. And I'm actually thinking about either selling a cash good put or straight up dollar cost averaging and buying more shares. So I will share the alerts with our members on Discord. So again, if you want to get access to all these alerts, link's going to be down below if you're interested. Support level is going to stay put at $85, $86 for Google. And last but not least, we got Microsoft and Shopify. Microsoft here, also red candle on a green day, so definitely suggesting a lot of weakness intraday. Support level is going to stay put at roughly 247. But my fair value is going to be the low 200s, considering how not really overvalued, but definitely trading at a rich valuation, right? So I don't think Microsoft is overvalued, but it is a bit of a pricey stock, right? It is, trading at a very high multiple, so to speak. So overvalued is kind of like this negative connotation that, hey, you want to avoid that stock at all cost. But Microsoft, I think, doesn't deserve that. Microsoft is a fantastic company. Like, even if you do buy like a 250, I think 5 years from now, you're still going to be making money, in my opinion, not as much as like market beating. You know what I mean? Like, it'll be much better if you were, I would personally be waiting for 200, letting the price come to me, and I would be dollar cost averaging at those levels. So the return is much higher than buying at 250, for example. And last but not least, we got Shopify, and Shopify on the day slightly down 0.66%, getting rejected at around $41-$40, and the next support really is going to be at 29, close to $30 per share. And at that point, there will be a potential swing trading opportunity for Shopify at those prices. So all in all, hope you guys enjoyed this video, and found it helpful, make sure that you subscribe and hit that like button. Don't forget to join our Discord and Patreon. There is a 16% annual discount that is available till February 28th. After that, it does expire and goes away, and you'll get access to all the alerts and private videos and all the channels and all that stuff. And the market's bottom line is that we are seeing a lot of indecision in the markets, a lot of uncertainty, lots of back and forth here, and I think that's very normal considering what we're going through from a more macroeconomic standpoint. We don't have all the answers. If we did, the markets would be more clear, more directional, and more precise in the way we were moving. Right now, it's very chaotic, and we're seeing, green days, red candles, but we're seeing red days and green candles. So lots of intraday sentiments kind of driving the markets also. And I'm kind of being very cautious in this environment, just waiting for clues, waiting for reports, waiting for data, and connecting all the dots to better assess where we are in this economic cycle, and of course when it comes to rate hiking cycle as well. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. As always, happy investing, and I'll see you all in the next video.